Joseph, 3 years ago, the iron ore price was $190 a ton, and the major producers, Rio, Anglo American, and BHP Billiton, all took this as a go flag to crank up production. Well, now they wake up, and it is late 2014, and the price is $70 a ton. Are these companies still profitable at this level?
Yes, they are. You have to understand that BHP and Rio, for example, can get this stuff out of the ground in Western Australia for like $25-ish a ton. And importantly, they think they can get it out for even less once they build out the infrastructure and so on. So this may go on. It has, however, been a very, very bad year if you have been trying to forecast iron ore prices and earnings for iron ore producers in particular. Like BHP, consensus earnings have fallen 40% this year for the next 12 months. Rio a third, Anglo 24%.
Well,
it's quite embarrassing, really.
But given that estimates have come down, stock prices have come down, is there value here now?
Yeah,
they're still profitable, right?
I mean, you get to the point where the cash coming from these miners smells good, and BHP and Rio have dividend yields at this point of about 4%. Anglo is getting there. That looks good, but if you have been getting earnings forecasts so wrong, you've been getting the iron ore price forecast so wrong, what makes you really confident they're going to cover those dividends in the way you want them to?
Right. So the 2015 dividend at these companies, how safe?
Well, Sean, BHP had its AGM this week, and it said, it will commit to its progressive dividend, which has not departed from even in the depths of the financial crisis.
Right. So they'll borrow money to keep that dividend, basically.
Well, I mean, no, again, consensus estimates were that it would have enough free cash flow next year to actually cover the dividend. So it wouldn't actually have to go out and raise debt.
But we know consensus
that's
is not reliable.
Yeah, exactly, that's wobbling. And this, this goes back to the original point, which is these companies spent a lot not so long ago. And sure, that spending is sort of sunk. They don't have to do it all over again. And yet when you're BHP and you're big and you're diversified, you're not just in iron ore, you're spending $15 billion or so next year, $10 billion the year after on copper, petroleum, and all the sort of commodities which will provide long-term growth for the dividend.
Right.
If iron ore keeps going down, do you cut that capex? Do you try and squeeze productivity out of it? Suddenly it gets a bit tougher.
And just in a few words, what's the Lex view? What is the proper strategy for these guys? Cut production? Keep going?
Well, this is the irony, that it's individually rational for all of them to get this low-cost supply out. But eventually, if high-cost producers do not come out of the market, or if sort of antitrust regulators start looking at this and think, well, look, why are you kicking, or looks like you're attempting to kick out, the mid-sized producers, it will get sticky, even if it seems like completely economically rational to continue the strategy.
It sounds like we have a collective action problem here. Thanks, Joseph.